All right, guys. So you're welcome back to the Complete Traders channel, and this is David. I want to say a very big thank you to you guys for staying around. I've been away for some time, but thank God I'm back, guys, and I'm going to be making good on my promise right now. Earlier on, I promised that I was going to give out a video that talks about fundamental analysis, and so I'm going to be giving you my definition of how you, as a retail trader, can carry out a proper fundamental analysis. Okay, so with this one, I'm going to be giving you an example with gold. So if you like gold and you like to learn how I look at fundamentals for gold, then you want to stick around. But more importantly, guys, I'll be giving you my idea of what fundamental analysis is. And so you'll be learning the blueprint of how to do fundamental analysis for any asset. So it could be currencies, it could be stock indexes, it could be Bitcoin or Ethereum, you know. So, but the blueprint remains the same. The concept remains the same. All right. Um, just that it has different applications in the different assets. Okay. So, but we're going to be giving an example using gold. So, at the very least, what you're going to be getting here is that you'll be seeing how to carry out an effective fundamental analysis for gold. Okay. So, this is the gold chart, gold dollar. Okay. And let me just give you a definition of what I call fundamental analysis. Okay, so that's where we begin from. So, what is actually fundamental analysis? This is how I define it. It means monitoring factors that are responsible for inflow or outflow of value for a particular asset. Okay, that is the definition for fundamental analysis, according to me. Now, I know a lot of people would define fundamental analysis as looking at the news, looking at all kinds and manners of things. Now, the reason why I don't do that is because as a retail trader, you don't stand a chance of, being very effective using that method. All right. But that's the method that is used by the big investors. And I really like to do it the easiest and the most effective way possible. If you have actually gone through trading with the news, you will find that it is really, really difficult to actually tell the trend of the market simply by using the news. Now, I found out the best thing and the most effective thing to do is to follow the steps of the big traders. Okay, not just based on price action only. All right, but I'm looking at certain indicators that tells me that the big traders are buying into an asset or selling out of an asset. This is how I do my fundamental analysis. And the key to doing this is to understand how the big investors define that particular instrument, how they use it. Okay? So once you found out how they use that instrument, how they define it, then you can monitor the events, all right, that can make them now to sell or to buy. Now, I'm going to give you an example using gold, all right? So how do big investors use gold, right? That's where you begin from. Now, here you can see gold is used as an hedge against inflation. So what the big investors actually monitor is inflation versus yield. Okay, because they seek to use gold, they mostly use gold as a hedge against inflation. So whenever we have inflation, rising inflation, then you would see gold becoming more attractive. But they don't simply just look at inflation, they look at inflation versus yield, because gold on its own does not produce any yield, and investors want yield. All right. But if you have a situation where in that economy, inflation is rising faster than the yield, or you have a situation where inflation is rising and the yield is actually dropping, then gold becomes very attractive, and gold should do fine, better than the currency of that economy. Okay. So in analyzing gold, you understand that you are going to be analyzing also the currency, okay, in which gold is quoted in. So in this case, we're looking at gold versus dollar, but you could also look at gold versus euro, gold versus Japanese yen. But all you have to be monitoring is what is actually happening with this particular currency based on inflation and the yield. Okay, inflation and yield. So if I'm looking at dollar, for instance, I have to know what is happening with inflation in the United States economy. I have to know what is happening with yield. All right. And then that will give me an idea of what the investors are going to be doing with gold. So will money flow out of dollar into gold? Now, money will flow out of dollar into gold when we have inflation rising faster than yield. And money will flow out of gold into dollar when you have yield rising faster than inflation. All right. So if yield is rising faster than inflation, investors will want that yield, and then they will move money out of gold that does not produce any yield and put that money in the dollar. But if you have inflation rising faster than yield, it means that investors will want to seek the protection of gold against that inflation, because inflation actually causes money to lose value. So in order to track this market, what we actually look at is inflation and the yield chart. So we are minusing inflation out of the nominal yield, and that gives us the real yield. Okay, it tells us what is happening with inflation versus the yield. Now, like I said, guys, it depends on the currency that the gold is quoted in. So if you are trading gold versus dollar, it means that gold is quoted in dollar in this case, and you have to be monitoring the inflation and yield of the US market. Here we have the US 10Y and then minus T10YIE. So this right here is inflation expectation. Okay, so when you have it like that, what you have on now as a chart is the real yield, the real yield. Now, what happens right here? When the real yield is going down, okay, it simply means that inflation is rising faster than yield. So investors will seek protection in gold. This will cause inflow of value for gold and make the price of gold to go up. When the real yield, on the other hand, is rising, this simply means that the yield is rising faster than inflation, and therefore investors will move funds, money out of gold that does not produce any yield, and now put that money in the currency that it is quoted in. Okay, in the currency that it is quoted in. Now, I need you to understand that if you are looking at gold euro, this is not the real chart you're going to be looking at. You're going to be looking at the real chart for the euro area. That's what you're going to be doing. Okay. So quickly, what you see here are some markings that I made. So this one happened very recently. We see when gold rose up right here very strongly. At that point in time, we also saw that the real yield dropped. Okay, the real yield was dropping here. And so that caused inflow of value for gold. Okay, now when the real yield began to rise again, this was happening because the central bank was talking about raising interest rate. And so because of this, the market began to sell out of government bond, the 10-year government bond. Okay, as they begin to sell out of the government 10-year bond, prices begin to go down for the bond, and that will cause the yield to go up. Okay, so the yield is actually the effective interest rate and it is expressed as a percentage of the price of the bond. So when the price of the bond goes up, the yield will go down. When the price of the bond goes down, the yield will go up. But understand that the interest here is fixed, okay? But because it is expressed as a percentage of the price of the bond, so whenever the price of the bond goes up, the yield will go down, okay? And whenever the price of the bond goes down, the yield will go up. All right. So here when the yield started rising, it was telling us that inflation here is underperforming the yield. So nominal yield is rising faster than inflation. And so investors will be enticed by that yield and move money out of gold into the dollar. Okay, so whenever the currency is losing value, that is when you will have investors buying into gold. Okay, and what tells you that that the currency is going to be losing value? Okay, when you have the central bankers talking about reducing interest rates, that is going to cause the currency to lose value. All right, because investors will be pulling money out of that economy and putting that money elsewhere. And you know that interest rate is an incentive for people to hold on to money. Interest rate is an incentive for people to save. Okay, and when you look at the whole thing that will happen to that economy, spending is going to reduce whenever interest rate is being raised. Okay, and then that will cause the value of that currency to go up. But because you have the yield as well going up, it means that investors will want to seek that yield. They will want to buy into that market, buy into that currency in order to take advantage of that yield. But at the same time, when the interest rate goes up, the carrying cost for gold goes up. That means the cost for holding on to gold rises. So each time interest rate is rising, the carrying cost for gold is rising. That's why the real chart is very important, because it tells us all of these things in one picture. Okay? So it tells us inflation, it talks to us about inflation, it talks to us about interest rate. And from whatever is happening here, we know that gold is going to be affected in a certain way, the currency is going to be affected in a certain way, and then we should know what our expectations are going to be. So for instance, here, when the real started going up, you see gold dropping. All right. Now watch this, guys. This was a very big opportunity, a huge opportunity for traders to make money from this. I saw this one live and I understood what was actually going on. This is pure manipulation. This is what I've been teaching you guys. So when you have this kind of understanding, you know what happens? You are at a very good position to understand when manipulations actually are happening in the market. Okay, now look what happened here. We saw that the yield was rising all through. This is a situation for gold to continue dropping. But around this area here, we saw that gold dropped and then bounced back up, breaking through this high. Lots of traders would have been trading that as a breakout to the upside, or as a continuation of this price push to the upside. And actually, they're going to be calling this one, support, broken, turn, resistance. I think that level. Well, around that area, they're going to be calling this support, broken, turns, resistance. Now, that would be wrong. You see, this is why it is very important for you to understand what is happening with the big boys. Okay, the reason for them to sell gold is right there in the market. The reason for them to buy gold, which will support the price of gold to rise, that reason is not there. They don't have any reason to support gold rising. Okay, that's because we have the yield going up. So the cost of holding on to gold is very high. And if they are going to be holding on to gold, that means that they will have to forego the yield that they would otherwise be taken advantage of. All right, so these guys know what they're doing, right? This is why we see price of gold dropping, because they have every reason to sell gold and buy into the currency. All right. That's the issue here. So you can see that now when we have this breakout here, we saw that real yield continued to rise. So this tells me already that this is an inflation. So when you have, this is daily chart, guys. So when you have that rejection candle alone, it gives you that information that you need, that gold is going to drop, because this is a rejection candle. It is bearish. And I've taught you guys here about this old pattern that is playing out here. Here we have two patterns playing out in one. This is the type 2 master pattern that I taught you guys. You can go and check out that type 2 master pattern. So here we have a bubble. Okay. So we are coming. So right here we have this push to the upside, and you see this was happening at the time when Ukraine was being invaded by Russia. Okay, so Ukraine was being invaded by Russia, and the news was just all about it. And so if you were just monitoring the news, guys, you see, you would be at a disadvantage. You would be at a very huge disadvantage, because the news did not stop talking about this for months. I mean, the invasion of Ukraine by Russia. So normally gold is used as a risk-off asset. Okay, but that means that when there's global tensions and when the risk appetite of investors is very low, then they should be buying into gold. Okay, so this was what actually caused this pump up in price, because people were thinking that we are in a risk-off environment, and truly we were in a risk-off environment. There was this talk of the world going into World War III and all of that stuff. But if you had monitored the real charts, you don't really need to hear what the news guys were saying. Okay, you don't really need you don't need all of that. Okay, and so when this was happening, we see that real yield dropped. This was because people started buying into the government bond, the 10-year bond, which is considered to be a very safe haven asset. And when they bought into the government 10-year bond, it caused the price of the bonds to actually rise. And then that will cause the interest rate to drop. Like I told you guys, the bond and the price are inversely correlated. Whenever the bond price is going up, the yield will go down, because the interest, this yield is the effective interest rate expressed as a percentage of the price of the bond. So whenever the price of the bond goes up, the yield will go down. Whenever the price of the bond goes down, the yield will go up. And that's how it works. So when they were rushing in to buy the government 10-year bond here, the US 10-year government bond, the price of the bond began to go up, which caused the yield to go down. And so we saw that inflation began to outperform the yield, which caused a falling real yield. And that was good for gold. So without looking at what the news was saying, this was very good for you to work with. Now, you see, while the news continued, all right, the media continued to talk about how, what was happening in Ukraine, how that Russia can use nuclear bombs. You see, the real yield didn't change. We saw that the real yield began to move higher. All right. This was telling us that gold was bearish. So if you were an uninformed trader just looking at the news, you would have rushed in to buy gold when we had the support right here. But if you had this chart right here, this is what I call fundamental analysis. You are looking at the factors that are responsible for inflow or outflow of value for a particular asset or instrument. You're looking at the factors that affect investors' sentiment for a particular instrument. That is fundamental analysis, not just looking at the news. You get the point now? Because the news can be interpreted in different ways. Some people can see opportunity from the news, while others can see, zero opportunity from the news. Right? And that will cause them to act. So your action has to be in line with the big guys who actually pour in money into this market. And you have to know the indicators, the things that they look at. that affect their sentiment, the things that they look at that influences their decisions to hold on to an asset or to sell off an asset. Okay, and this is what I've been talking to you about. I'm just using Go to give you that example. We have models like this for currencies. I actually have 3 models for this for currency. I have something like this for Bitcoin and stock indexes, and you can check on me if you have interest in that. Okay, so that is it for this one, guys. You will be able to download the books, like I said, the book for this one, right in the description below. But if you check there and it's not there, you can message me and you will be able to get it. All right. So cheers and God bless you.